welcome to this episode of Nucleus Wealth Empower, where I go looking for what the good life is and how finance can support and empower us in achieving that. In today's episode, we're going to look at buying your first home. Personally, this is my number one financial goal for such a long time, and it was and continues to be one of my key assets to living my good life. And while I know that's not going to be the case for everybody, whether you want to buy your first property from a consumption perspective like I did, or from an investment perspective, or even both, hopefully today we can shed some light on how to do it for you. Before we get into the show, though, as usual, I'd like to start in the spirit of reconciliation and acknowledge the traditional custodians of country throughout Australia and their connections to the land, sea, and community. I pay my respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. So, to help me get into the nitty-gritty of buying your first home, I have a special guest today, Steve Crawford. Steve is a money coach who's been in the financial advice industry for over 15 years, working for the likes of MLC and being part of the leadership team at the Association of Financial Advisors. He founded Experience Wealth in 2008 and Your Spending Coach in 2013. Welcome to the show, Steve.
Hey, Shelley, how you doing?
Yeah, great. Yourself?
Pretty good.
Excellent. Are you stuck in lockdown at the moment?
Yeah, just another day. What is it, 200 and something?
No.
We've cracked over in Victoria now, so just getting through the grind.
It's tough, hey? I think you said you had kids.
Yeah,
is that at homeschooling? So you're really carrying a load there.
Yeah, they're a little bit older, so they're at least. I just got actually a call with a client from Sydney who has, I think, just one son, grade 1. So I know all the parents of young kids are struggling.
Yeah.
Mine are 10 through to 17. So they're a little bit more self-sufficient, which makes it a little bit easier.
It does. Still tough though. So props to you and all the parents out there doing such an amazing job. Okay, so before we actually get into the topic of buying your first home, I want to actually speak a little bit about your experience. So maybe if we start off, can you tell me what you do as a money coach and what sort of clients you get?
Yeah, so as a money coach, there's probably 2 or 3 terms that you could replace it with. So money coach, cash flow coach, financial coach. Basically, it's the easiest way to explain what I do as a money coach in Experience Wealth is we help our clients make smarter, more confident decisions around their money, but specifically 3 things. Things they're saving up for, which typically always comes from property, families, and then kids. I mean, there's other stuff like big one-off money things like weddings, moving in together, buying cars, travel, big travel, stuff like that. So it's basically helping people understand the real what's hitting my bank account or hitting our bank account. How do we use that? What do we put it towards? How do we make decisions around that? So we like to talk about 3 elements, being the planning phase, the tracking phase, and the coaching side. And so my job is to help them plan, track, and then coach them towards their money goals, sort of outside of the traditional financial planning stuff. So no longer do I talk about superannuation or investments or insurance. It still gets spoken about from a client's perspective, but it's not something that we help them with directly anymore. We work with financial planners to do that and finish that part of the job.
Cash flow to me is so interesting because that's like the real nitty-gritty of how you're living your life, right? All of those are decisions around today. And I mean, of course, obviously to a lesser extent to what you want tomorrow to be like, but sometimes superannuation, I noticed on your website, you talk about the stuff like retirement planning can, if you're in your 20s, be a hard concept to connect with when it comes to your money. But when you're thinking about it in terms of your life and your lifestyle and, what I like to find out what is here, what is the good life, really that's what's important.
Yeah, and I think that's why I broke away from, or gave up my we had our own financial services license. So did the full journey, started with a big institutional licensee back in 2008, sort of learnt what people thought advice was. such as like, because I'm 43 now and have been doing this for 20 plus years. Again, I refuse to update my LinkedIn profile, so it still says that I've been doing it for 5 minutes, but it's like a decade on the inside of the fence, in terms of investment management, practice management, insurance, and stuff like that. And then more than a decade running Experience Wealth as our standalone, what was originally day one, a financial planning firm targeting Gen Xers and millennials. Back in 2008, no one was really talking to Gen Xers, let alone millennials. I think millennials were still in school. So to have a business that was targeting that demographic, which is mine, I'm a Gen Xer. Yep. At the time, you just didn't do it. It was, if you spoke to people that were Gen Xers, who are all now in obviously their 40s and early 50s, about money, it was, so how much do you want to have when you retire, or how much do you need if you die? Like, that was the whole breadth of the conversation. And the connection for why we started the business and the connection to today's conversation is, my wife and I, when we were starting out, we were a lot younger. So we wanted to get together, get married, have kids, buy a house. And it was our first time around, and we were both in the industry, both in the finance industry. So we theoretically should have known better, but the industry just, when we got pregnant earlier than we thought, we were still trying to save money to buy our first house. We were living in Sydney. We bought our first home. We bought our home in Melbourne. Amazing. And that whole exercise was just, it was horrendous to navigate. And we were in the industry. So,
I feel the same way.
Yeah.
Like, I have worked in the financial services industry for my career since 2008. And now I'm at the point where I'm like, I don't know very much about managing my own personal financial situation. Like, it's actually a bit pathetic. So, I'm here to be taught, that's for sure. That's why I'm asking the questions. But yeah, when I went to buy a home, I was definitely struck by how much stuff I didn't know about it. So,
yeah. And I think that, again, it comes from, you got to think about like who's driving the first home buyer industry. And it is a bit of an industry in the sense that it's not, you can purchase your first home without needing any sort of professional advice. So it's not like, if you want to purchase investment products and you want to get professional advice from a professional advisor, then you can go through a whole process to do that. Sure, there's a lending process and it's wrapped up in a credit regime to ensure that there is responsible lending. But the clients and the consumers, really sort of everybody pushes the responsibility of, we talk about it all the time with our clients, there is a huge difference between how much you can borrow and how much you can afford. And you need to think about affordability more than just how much do I need to spend? How much less do I need to spend when that repayment goes in?
Yeah.
And that conversation just doesn't happen.
Yeah, absolutely.
It didn't happen 20 years ago or 15 years ago when we bought it. And it still hasn't happened now, but despite the amount of pressure that's been put on the people that are largely responsible for driving this conversation, which is the banks, to improve the consumer's understanding and the first home buyers understanding around, can you actually afford this thing?
It's really scary, some of the stuff that they offer you. Like, in the same way that, they might offer you a credit card limit upgrade when you max out, which I don't know if that's the best time to getting one. But when you apply for a bank for a mortgage, sometimes what they think you can afford is it's hard to get your head around how you can actually afford to pay that.
Yeah, it's pretty scary
what that's
too.
going to mean for your lifestyle as well, like you say.
Yeah. Like, and everybody, I mean, the thing that scares me the most about the people that don't get help. And so, like, if you go to a really good mortgage broker, they should be helping you. If you go to a good financial planner, even though it's technically not their job to do this stuff, the good ones will still do it.
Yep.
If you go to a financial coach or a money coach or a cash flow coach or someone like us, it's our bread and butter. So you'd expect us to do it, right? So and you'd hope there's some people giving them help, but the people that tend to just walk into one of the big four and either walk in, because no one really walks into a branch anymore, everything's done online.
Yep.
And has been forever, right? And so they go through a pre-approval process, which is either a proper pre-approval or a crappy one that doesn't really mean much.
Yep.
And invariably there'll be a number that'll get spat out at the end of it of how much their borrowing power is. And 90% of the people, this is just my own opinion, 90% of the people that look at the borrowing power number, when they talk to me, they immediately turn around and the next words out of their mouth is, they wanted to offer me, they said I could borrow this much, but I don't think I can afford that. And it's like, so straight away they know the number that they're qualifying for, they can't afford. The scary thing is when people don't then do the next logical steps, which is, well, if I don't think I can afford that, how do I know how much I can afford? That's what they should be doing. The scary thing is when people take that number and go, well, if the bank said that's my affordability level, and off I go, even though subconsciously, and with some of them, it's not even subconsciously, it's consciously, they are walking into it going, I don't think we don't think we can afford this, or we don't know. But the fear of being left on the sidelines scares the shit out of them so much that they'll just jump and hope for the best.
I mean, more than a lot of other investment decisions, there's so much emotion tied up in this that you can understand how this, irrationality or cognitive dissonance, whatever you want to call it, comes into play. I'm conscious that we kind of got into the meat of this really quickly, so I am going to put it on pause 1 second and just ask listeners if they can hit the like bell on YouTube if they like the show and want to support us, or subscribe as well through YouTube or your preferred podcast platform. So, Steve, I had originally thought in my head that I would start this off in terms by posing the question to you: where does somebody start in terms of making their dream of owning a house a reality? Like, what is the first step? Because speaking to some of my colleagues who they're in their 20s, and I remember feeling like that as well. Is like, and house prices have only gone up more than inflation since I was in my 20s. It feels so overwhelming that it doesn't even feel like there's any potential to make it reality. So what is the first thing that you could do when you feel like it's not possible?
Well, so the first thing, and look, if it's not possible, it's not possible, and that's just the cold hard reality of the world that we live in. But fortunately, with a lot of the lenders are getting better at things like parental guarantors and other support mechanisms, because my experience is it's actually almost cheaper now to pay a mortgage than it is to pay rent, especially in Sydney and Melbourne.
Yep.
So it's not the repayment that tends to stop people from being able to do it. It's the deposit to get in, to avoid lender's mortgage insurance, which is obviously the basically it's dead money that you pay the bank in order to protect the bank's backside in case you can't afford to make the repayment and they have to sell the home out from underneath you. And if there's a shortfall, that's what that is. And if you borrow any more than 80%, in most instances, you're paying lender's mortgage insurance. Plus you got stamp duty, even though there are concessions in states now to try and make that more affordable.
Okay, so just pausing there as well. So you're saying 80% is normally the maximum you can borrow before you have to pay mortgage insurance. So what does that mean you need to have in cash up front as a percentage of the property value?
So it's 20% plus. So the mortgage brokers or mortgage brokers and people like myself that will help out with how much do you need at the start. They'll talk about how much do you need at settlement. So settlement is when you actually take over the property, when you own it, right?
Okay.
So you need your deposit, which is anywhere between 10 and 20%. Can be less than that if you are paying lender's mortgage insurance, but it's basically the gap between what you're paying with your own money versus how much you're borrowing,
Okay.
and then any of the stamp duty costs,
Yep.
your conveyancing costs, which would be, $1,000 to $2,000 for a good conveyancer to do a good job, and then anything else that you need to pay, like government charges and things
Okay.
like that. So you'll typically, it's very, very rare for first home buyers to walk in with a 20% deposit saved
Yep.
these days. I would argue most of them would be coming in between 10 to 15%.
Okay.
And then they're looking at things like parental guarantors to try and soften the blow, and basically borrowing mum and dad's asset, being a home, to increase the asset value,
Okay.
which allows them to have a total starting loan balance that is less than 80% of what the combined asset is. So
Okay.
basically to try and avoid paying lenders
So
mortgage insurance.
the combined collateral is kind of what
Yeah.
you're doing when you get a parental guarantor to
Yeah.
get you to that magical, hopefully 80% mark where they don't charge you mortgage insurance. Okay. So mortgage insurance, can the loan cover that, or is that more cash that you need to stump up?
Some of them do, but usually most of them would go 90% plus, or maximum 95% borrowing, which would need to include lender's mortgage insurance. Anything over 90%, you can still do it in some instances. And again, I'm not a mortgage broker, so you got to get a credit representative to tell you, because these policies change all the time.
Okay,
You
right.
could
Yep.
borrow a little bit more, and it's not the lender's mortgage insurance, the way it's calculated, it's an exponential cost increase. So if you borrow between 80 and 81% of the value of the home, meaning you put in 19 to 20% of the deposit, then your lender's mortgage insurance compared to the value of the home that you're buying is on the lower end. And then it goes up for every extra percent that you're borrowing. But typically what happens is, as soon as you get over 90, it kicks massively.
Right. Okay.
And that's the market and the lenders and the lendage mortgage insurers trying to mitigate their own risk by disincentivizing people from borrowing more relative to the value. Because then if there's a dip in what the market, dip in terms of the value of the property, then that's where you start to get into that at-risk territory. So your question was, what's the first thing they should do? The first thing they need to do is they need to understand how home loans work.
Okay.
They need to understand all the components. What is stamp duty? What is lender's mortgage insurance? What is a deposit? What's the difference between a private sale and auction?
Okay. Yep.
What happens if I put my hand up to bid? How much deposit do I need to put down?
Yep.
Do I need to get a property inspection?
Okay.
And all the practical stuff. They need to do as much research as they can to find out what the steps in the process are to actually buying a house is.
Okay.
So that when the time comes that they're ready to go through that, they don't want to be shocked. But before they even get to that point, they've got to figure out what their goal is around the house. So whether it's a place, like you said, you live in your place.
Yeah, I live in my place. Yep.
Yeah.
It was
So for
definitely
you,
consumption.
So for you, it was always, although I strongly encourage you not to actually eat at the property, because that will lower the value. If there's strange teeth marks in the door. So obviously you moved, you bought your place. Is it your forever home?
No, which
Right.
makes it sound like madness. Well,
Right.
it depends. I guess it depends what happens.
Hopefully not. Right. So you got to think through. Okay, what's first, what's next is what we like to do. So even if it's a place that you're going to live in for a while or rent out for a while, like what's the next step apart from that? Because if you're going to live in it for a while and then do you want to keep it when you move out?
Oh yeah, I guess it depends what happens.
Well,
Like, it's
if you can afford it.
It's interesting. Like potentially, yes, it's interesting how COVID kind of has changed how I feel about that, in the sense that it's relatively close to the city, and that may just not be as interesting to people as it was before COVID because of working from home. So, Yeah, I'm not sure the answer to that question.
Yeah. So I think that the best property and buying homes, and because I'm 43 and I'm a dad, I do dad jokes probably way too much, but for me this one
Good.
just
I'll
makes
laugh at
perfect
everything.
sense. The when people are thinking of buying a property, for me it's like they get confused between, or they think about it the same way as they do a wedding and a marriage. But all
Yeah.
they do is all they do is focus on the wedding part,
Yep.
which is the awesome bit of, yes, we got the property, not shit, we've got a mortgage that's linked to this thing for the next 30 years. It's the one marriage that you want to get out of as fast as physically possible. But you got to think through
Yeah.
what are the next stages. So why am I buying this, or why are we buying this? Is it because it's a place that we want to move into together and we can see ourselves here for X number of years? Or is it because we want to get our foot in the door on the ladder, and we don't want the ladder to keep moving up and us not being able to get into it? And we're really only going to be there for as long as we're going to be there? Or is it we're going to buy something, put somebody else in there until we can afford to move in, and then eventually we want to move in? Because all of those different permutations, do we want to turn this place into, we're going to move in, we're going to buy it, we're going to move in, we're going to live there for as long as we have to, but it's not even our next home, and then we'd like the option to rent it out,
Yep.
if that makes sense, and then go and buy somewhere else. So the more you think through what do you want to use it for, the easier it gets when you get to the next bit, which is, okay, well, how much can you actually afford? What are you, and because then you can change your numbers around, well, are you going to be renting it out? Are you not going to be renting it out? If it is being rented out, is it in a highly sought after area? So you know it's going to have good tenancy rates. Can you be more confident about the money that's coming in? Or is it in an area where you're going to struggle to rent it out in the future? So it's really, everything we do with all of our clients is goals based to begin with.
Okay.
But they really need to think through not just the goal, because I think quite simplistically from a first home buyer's perspective, you go, without help, people would do the logical of, we want to buy our first home. It's like, well, yes, that's clearly the objective, but then what?
Yeah.
So get them to think beyond the first 12 months, 2 years, to that point of, if it's not the forever home, when would you like to move out? What's coming next? Would you want to rent it, or wouldn't care? You'd be happy to sell it? Because that not only helps them define the parameters through which they make the decision, it helps them define, affordability in terms of their repayments, because they know where it's going to be rented or it's not going to be rented. They know whether they're just going to have to make the minimum payment on the loan, or whether they're going to have to make accelerated extra top-up payments so that they can get ready for what's next. And it just helps them. Navigate the way through the decision a little bit broader than, we just want to get our foot in the door and we want to get on the market, and when we're in, then we'll figure it out.
There are such different frames of reference, I think. Like when it's sort of, I just want to get my foot in the door, well, you are thinking about or evaluating potential properties within that terms of reference completely different than, as you say, I want to live in it for 5 years and then I want to rent it. Okay, is it going to be suitable for that?
Yeah, spot on.
Okay. So, where do you start if you're a dreamer? I'm gonna add, Steve, if you don't mind, with a good savings plan and a cash flow plan, and so your spending coach might be somewhere that people can actually start saving for their deposit. But then understanding all of the mechanics of how the transactions work. So I don't know, if I was going to say practically, thinking back on my journey, maybe you can add to this. My advice to myself or younger self would be, go to look at properties and ask agents for the contracts and read through them in advance so you can understand. That's what you're going to be agreeing to. You can understand some of the mechanisms of it. But then, of course, you went through, all of the different mechanisms in terms of private sale, auctions, mortgage brokers, and that sort of thing. So, and then I guess the third point if I'm summarizing where we've got to so far, is the why of why you want to buy a property.
Yep.
Okay. Alrighty. So once we've established that, what's our next step?
All right. So let's unpack affordability a little bit, because that's probably it's so much easier to not get caught in the emotional side of the decision making process when you have an actual number in your head, either individually or collectively, that is effectively your walk away point. So we talk about lifestyle proofing your property purchase, and within that you have a lifestyle limit. So and the lifestyle limit is the maximum amount of debt that you'll start with day one. That's been lifestyle proofed, and any level of debt above that, i.e. if we borrow more money than this to get into the property that we want, anything above that is not acceptable for us.
Okay.
And normally you have a hard limit and so you have an ideal limit and a hard limit, and there'll be a gap between the two.
Yep. Okay.
Don't just go with one number, because when the auction goes and you get close to that number and you think you can get it for $5,000 more and you've only got one number, it doesn't work. Yeah. And you're going to cross it. And the problem is then you won't know when to stop. And 5 becomes 10, becomes 15, becomes 20, becomes 50. And we all know how agents, I'm sure they're far more reputable than what they are now. But if nobody believes that a bank will lend them X amount of dollars, nobody believes that the price that's listed in the range that the property is actually going to go in that range. It's 10 to 20% above the upper end.
Yeah, that was my next question. How do you look at these things?
You just call bullshit on it before you even get there, and and people have already started doing that. So I think that is one thing that I think first home buyers are probably a little bit more educated on now, is the expectation that it is not going to go for what the sticker price is. But so going through the exercise of what's our limit, what's our lifestyle limit, and again, you're working backwards from, if we already had this mortgage and we picked that mortgage up and we dropped it into our normal budget, our normal week to week, month to month, year to year budget, what does that do to us? So that's the first thing. Most people then make a really poor decision when they don't get coaching at this point, because all they'll do is they'll pick up the current mortgage repayment amount and drop it in based on where rates are today. And we're at all-time record lows. We're nowhere near where the rates should be, as they would be over a 30-year loan term.
So what do you do with that at the moment when you're making cash flow calculations? Where do you go to?
Yeah, so it's really hard. I think the link that I think we're sharing
in the show notes. Yep.
Yeah, a calculator that people can use to build a budget. And I think one of the things that might be in there could be a link around interest rates, and if it's not, I'll make sure that it is. But there is a link to the RBA cash rate, and then there's a buffer that gets put on that. So look, the general rule of thumb is what the lenders are lending at. They'll do what they'll call a serviceability test, which basically means, can you afford to make the repayment if rates were where they are now and they go up? Can you still service or pay the loan? And they'll look at anywhere between 2 and 2.5% as a general rule, on top of where the current rates are. So if rates are sitting around 2.5, then you should be saying, well, can I afford to make this repayment if rates got up to 4.5 or 5?
Okay. Yep.
So always adding a buffer of about 2.5% is a good general rule.
Okay. Yeah.
So, and that's what you want to be able to do, right? And it's not just even if it was interest only, because I know some people, first home buyers, might be lured in by the prospect of not having to pay down the principal at the start. Although I think the industry or the lending industry has gotten a lot better at not actually offering interest only as much to first home buyers.
More to,
although the rate gap between interest only loans and principal and interest loans is getting closer and closer again. Which, look, depends how you look at whose job it is to make this decision, right? So if the banks go,
absolutely, yeah.
It's our job to do a risk assessment to a point, and we've only got to jump through the hoops that the government wants us to, and the regulator wants us to jump through.
And their shareholders.
And as long as we jump through those hoops, there's got to be an element, and this is where I get a little bit of people not liking me very much. There has to be an element of pushing stuff back onto the consumer to go, guys, if you're going to take on an $800,000 or a $900,000 mortgage and you don't know if you can really afford to do it, if the bank's stupid enough to give it to you, you're stupid enough to take it. Like, you can't blame everybody. And look, there's a middle ground, right? So the affordability bit, stress test, first things first, pick the current mortgage repayment up, drop it into your budget. If you don't have a budget, build a friggin' budget and figure out what it actually costs for you guys to live and have a life, and then identify what minimum decent lifestyle is, because that's what the real world's going to be when you have a mortgage to repay. Not maximum, minimum. And minimum is what you're going to be living off, right?
Yeah.
And then stress test the mortgage to say, okay, if the rates went up, and you can just do this with any online banking calculator, you can adjust borrowing calculator, you can adjust the rate, and it'll tell you what the new loan repayment would be. And just see what happens. When do you start getting to a point where you don't have enough?
Yeah. Okay.
So trying to do it, that's one way to do it. Make sure you're looking at that. Another way to do it is to look at, do you have, even with the mortgage repayment getting put in, would you have leftover money, excess savings, right? What we call free savings. So money that isn't earmarked for anything else, that in theory you could pay off the loan. And then what you want to do is say, okay, well, if I can make extra repayments off the loan, could I put in enough each month so that I turned a 30-year loan into a 25-year loan or a 20 to 25-year loan? And if the answer is yes, so this is just our own internal we have sort of three ways we measure affordability. One is, does it fit into the budget, and what percentage of your income a mortgage and all your debt obligation takes up. And for us, our comfort zone is between 25 and maximum 35%.
Okay. And the banks, they use 30-ish or?
No, the banks will use a couple of different measurements. So one will be the servicing. There's also a rule of thumb where they'll go off a multiple of income.
Okay.
That's another thing that sort of tells you that prices are way out of whack. When we borrowed, the average general rule of thumb was about 4 to 5 times income. And I've heard some banks are running at 7 to 8 to 9 times income now. So you go 7 to 8 times income combined with lowest rates in the history of the universe equals a whole bunch of stuff that's way overpriced. Which is why the property market's starting to come off now, and people are starting to realize that, that's just drunk levels of stupid with what people are borrowing. Right. So that's why trying to avoid, if you don't trust the bank, if you don't trust the bank's ability to actually say whether or not you can afford something, and you have to do it yourself, then use common sense. If you're paying, look at how much rent you pay now as a percentage of your income, and then compare the mortgage as a percentage of the income, and see if it comes around that sort of 25 to 35% space. If it's more than that, freak out. It's too much.
Okay.
How many times your income is the mortgage when you put it together? If back in the old world with Steve and Mel and all the dinosaurs, when we bought ours, and you can hang shit on us and go, oh, well, it was different back then when, there still wasn't electricity in Melbourne because things were cheaper. You go, oh, sure, it can't be 5 times, but would you be comfortable if it was 7? Would you be comfortable if it was 8? Would you be comfortable with it being 9?
That's the thing. It's really a personal thing, I think. You have to decide what you're comfortable with. It's only really you that knows how you feel about your job situation or, your life or things like that. And also personally, like some people are way more comfortable on their minimum lifestyle than others. So, test it out beforehand.
Yeah. And no, again, it's the journey, right? So if you're getting in and you're 2 or 3 rungs below your career earning capacity, right? And your salary is going to go up and you can handle it at where it's at, but you think if I get this pay rise and it's going to go to here, and then my numbers will look like this, and then that'll be okay. I can put that extra payment that I'm not used to getting now. If I put that on the mortgage, and it goes from a 30-year to as I said, 20 to 25 for us. If you applying for a 30-year loan and you drop the repayment in on an average of about 4.5%, and you had leftover money, if you pick that leftover money up each month and you just paid that off the loan, how fast would it get paid? And we do this calculation for all of our clients so that they get to see it, but you should still be able to do it with some online calculators. Yep. A 30-year loan, if that turns into anywhere between 20 to 25, then you're usually in a good spot.
Okay.
15 to 20 is amazing. 25 to 30 years, you could be taking on a little bit more debt than what you could handle.
Okay. Right.
So those are the three different ways. Pick the number up, drop it in. What does that look like compared to what you're paying for rent?
Yep.
What percentage of your income does that represent? And if you had extra money for making extra repayments, how fast would the loan be paid off? Once you get those three things together, then that sort of gives you a level of debt as you wash it around a few times. Then you get to a point you go, okay, this is our number.
Okay.
Anything above this is less than ideal. Here's our ideal, but here's our maximum that we'd go to. And typically what's going to happen is the bank's borrowing power that they'll give you will be another 50 grand or some stupid level above that. So, somewhere between crap, no, that's way too much debt at the top, and God, I can't buy a shoebox for that, which is way down at the bottom, is your ideal point. And then just have a buffer so that if you go to auction, you go for your target, but when it gets above it and it gets that to that walkaway number, you can emotionally detach and go, nah, it's not for me, because it's not valuable. The property is now overvalued relative to what's important to us. And so we distance and we walk instead of just feeling like you're constantly missing out on stuff.
And so do you feel like your clients, they're actually super comfortable with doing that? Like, because as you said, it helps take the emotion out of it when you've talked about all of the, I guess you've scenario tested in a way, and you know that if you pay that number, what it's going to mean for you. And so actually then it becomes really easy to walk away from it.
Look, I'd never say it's super easy. They still get upset when they miss, as everybody does, but they know there's a next one coming. They know what it means. They know why they don't want to go over that number. Okay. And they've stressed it. I mean, we do a whole values goal planning exercise, financial independence statement exercise with them. So before they even get to the point of quantifying how much they want to allocate to a property purchase or a renovation or whatever it is, they understand what money means to them, and they understand how they're hardwired to make decisions and why they want to do things and where they want to call limits. Yep. So they're better prepared for the big decisions, which empowers them to be confident to walk away from stuff. I think that the risk of people doing this by themselves, if they don't have somebody, and whether it's a friend or a family member or a coach or anyone that they can just run the scenario and just talk about what's going to happen and how are they going to handle it when it gets to their limit and it goes over, because it will typically. Yep. How are you going to handle that situation? How are you going to try and be unemotional? And the more that they can prepare for that and practice it and scenario test it, then yes, they'll walk away. But we had a client that bought, it happens all the time with us, but we've had a client that, it's funny, the number doesn't change. So we've had first home buyers that go in the hundreds of thousands. We've got first time home buyer couples. So they've got their own property individually and now they're doing it together. Yeah. Still the same exercise, because it's just it's their number now instead of individual numbers. Yeah. Okay. And we've got clients that are in their 50s that were looking at making a purchase at $8 million a few weeks back. And all of them still call me to say, okay, I know we've gone through the numbers and I know you said we're okay to do this and we've looked at it, but can we just look at it one more time? And I think so what they tend to do is they tend to get into a really good habit of, let's go through it. Let's make sure what our limits are. They feel more confident when they go, just to sort of, pump themselves up. Okay. So it's not, and yes, you're far more subjected to this fear and anxiety and fear of missing out and not knowing when you're a first home buyer.
Sure. Okay.
But that's where you can sort of leverage off, again, friends, family members, and don't go to, look, unless it's someone like us that does it all the time, with all due respect, don't talk to your parents if your parents haven't bought a property for 15 years or 20 years. Go and talk to a friend or a
Okay.
cool auntie or a cool uncle or a cousin or someone that's done it in the last sort of 12 to
Okay.
36 months and get the real world, review from them.
Yeah.
What worked, what didn't work, what happened that you had no idea was going to happen, what was something that you just went, oh shit, I didn't even know I had to do this. Ask them that stuff.
Okay. Okay. Interesting. Don't go to parents.
Look, go to mum and dad for the bank of mum and
Yeah,
dad so you can
exactly.
borrow. So you can say, Mum, can I just borrow the keys to the house? Why is that? I just need to give it to the bank for a little bit so that I can use it as security for a loan. I promise I'll give it back to you in 5 to 10 years. So go to them for that. Don't necessarily go to them for, how's
Okay.
this thing going to work? Unless mum and dad are obviously experts in this space and they do it all the time, in which case go to them.
And what about social media then? That sounds like, I mean, is that not an extension of your mates, or
You
is it
probably shouldn't ask me because I'm never on social media either watching or participating, hence why my LinkedIn profile wasn't
was
updated.
old? Okay.
I think there are some good property experts out there now that are helping people demystify the process.
Okay.
Unfortunately, they're probably few and far between still. I think a lot of them still have vested interests.
Yeah. Okay.
I'm not a massive fan of trusting people that come from the property space itself
Yeah.
because they get paid to sell.
Mm.
So it's quite hard. I think going to educators and even financial coaches, financial advisors. I know property's less affected by this as maybe other sectors where there's a whole finfluencer movement coming now that it's sort of propagating or pushing certain paths as a key to success.
I think you hit the nail on the
Property not
head
so much though.
when you
Property not
said
so much.
you need to be aware of what their motives are. Well, how are they getting paid? Are they getting paid by someone selling this stuff to be putting this content out there?
Yeah, I think that the huge difference between like now and when we bought in 2006, so it's a long time ago, is there's almost too much information available now, and it's constantly updated. Everybody's an expert, but all the gear and no idea sort of expert because there's no they don't care if they don't know you. They don't, if you buy something and walk away, like they don't give a crap. They're not sitting there picking up the pieces. And we've had clients over the years that have had to sell houses because they'd bought before they saw us. They didn't do the stress testing. And I've had that meeting once, fortunately, only once in 15 years. And I hope to never have to have it again, where I literally had to say to them, you cannot afford your house anymore. You have to sell it. Otherwise, you're going to be broke in 6 months' time.
Wow.
That was horrendous. And it happened because people didn't know what they were doing. So I think that you got to sort of face into the scary part of feeling like you don't know what you're doing, accept your own limitations around what you do know, find somebody that you trust, even if they don't know the answers, that they'll know somebody to talk to and ask them to go with you. And that's where mum and dad could be really useful. If there's something where you do want to bring them in to the conversation, do your research, do as much as you can. There's no harm in looking at social media, but I think it does, there's a lot, everybody knows this. There's so much good stuff in terms of the information and then so much bad stuff in terms of the false realities of what they're getting versus what they can't get.
Yeah. Okay, so we've got affordability. Where next on this journey?
Well, I think there's the practicalities. So they've probably gone through either through a mortgage broker or through a bank directly to get their approvals, their proper approvals. So make sure for us, we go all the way through to effectively what's called a conditional approval, which means that the bank will lend you the money conditional to the property being worth what you're going to pay for it. So they do sort of verifications around your income, because ultimately that's what you want. You don't want to be going to buy a place and then having your application fall through because the bank, when they start scratching the surface much. And that's what a lot of the pre-approvals online are. They're pretty garbage because they're not even at that sort of what the banks would call an unconditional approval. stage, it's really not worth the paper that it's printed on, or even not
Okay.
printed on.
Okay.
So going through the process and having a good mortgage broker who will tend to do this with you. We're obviously huge fans of mortgage brokers over going direct, because you then get choice and you have somebody working for you instead of working for the lender.
And so finding a mortgage broker, there's things you need to be aware of when you do that?
Again, look, referral's really good. I mean, you want to go with someone that you trust, who's worked with somebody that delivered a really good experience. The really good mortgage brokers are the ones that do the longer term sort of, what do you want to buy this property for? Not just, here's what rate I can get and here's how much I can get you to qualify.
Okay.
They're the ones that work through all the pros and cons of different types of products. Should you get offset accounts? Shouldn't you get offset accounts? What happens with the credit card that comes with the mortgage? Do you really need a big limit, or don't you need a limit? What about repayment types, interest, principal and interest only? They have a method and a logic around, do you fix rates or don't you fix rates? It's not just, I can get you this from this lender with this really sharp rate. It's so much beyond that. So having somebody that helps you with that and walks you beyond the settlement. I think a lot of so much of this is executed on the other side of, once you own the property, making sure your accounts are set up properly, teaching you how repayments work. It still amazes me to this day that people don't really understand how mortgage payments work, even how stamp duty, who pays what when. The more they can help you with that stuff, and you want to see their capability. So ask them when the last time was that they helped a proper first home buyer go through the process. Ask them how they helped them understand how much they could really afford, not just how much they could borrow.
Perfect.
And see what they say. And if you don't like their answer, thank them for their time and move on to the next one. There's enough of this. I mean, for not me personally, but Brett, who's the best, he's in our team. Like, there's enough really good ones out there that you don't have to deal with effectively people that are just chasing a loan, which is one, unfortunately, not very, very few, but some of them would. If you don't understand the process, and you probably wouldn't know that might be what's happening as well. So again, go from referrals from people that have actually been through the experience in the last 12 to 36 months. Not, I dealt with the broker 5 years ago or 10 years ago and they were good to me. That's, but what have they done lately? That's what we're after.
Okay. And ask them those questions.
Yes. And don't be afraid to ruffle a few feathers, because if they can't answer tough questions just in an initial conversation, what's going to happen if things get a bit funky at the pointy end of a loan application, and they've got to go into bat on your behalf to make sure that the lender understands, that you don't represent an increased risk for whatever reason.
Yeah, right. Okay. All right, I'm conscious of time.
Yes.
Is there any last things that you think we've missed that we should cover? Or have we just about got there?
No, I think, look, again, I always start with the end in mind. Just go back to the basics of, or what I would say are the basics of, why are you doing this? What does it mean to you beyond just the purchase?
Okay.
If you're doing it with somebody else and it's both of your first home purchases, and quite often, people might even buy a property together before they get married and stuff these days. So set the ground rules down in terms of how you guys are going to make decisions around this. We had one the other day where clients were even going through the exercise of figuring out if they were going to go joint tenants or tenants in common, which is a whole different ownership structure, just in case things didn't work out. You got to get, it's so much easier to have the ugly, uncomfortable conversations maybe over a glass of wine on a Friday afternoon and hypothetically go, so let's say this all goes to shit and one of us decides to leave. How's that going to work?
Yeah.
Like, just go through everything. Don't leave any stone unturned, and have the conversations to the level that both of you feel like you're productively having the conversation. And even if that is you just on your own.
Yep.
And when you reach the point where you feel like it's unproductive or it's not working, think, who can we bring in to help us do this?
Okay.
Because you want to do that before you sign up for a 30-year mortgage on this beautiful new amazing house that you've just bought, not 3, 6, 9, 12 months later when you're like, oh crap, we didn't even think about this stuff. So
contingency
do the work
plan.
up front. do the work up front. The work up front is more than how much can you borrow, property profiles, proximity to shops, capital growth prospects, and all of that sort of garbage that no one can actually predict. It's the real world stuff around what happens inside the four walls when you guys are in there. That's the stuff you want to have conversations around, how you're going to make the payments and what happens if things get a little bit tough from time to time. Like, how are we going to deal with this?
Yep.
And then know who to go to get some help.
Fantastic. Speaking of, do you want to share with the listeners how they can get in touch with you or hear more from you?
Yeah, so website experiencewealth.com.au. Everything that we do is on there. There's a button that they can click a link to book a chat with myself, completely complimentary. Or we're a fee-based business, so everything is explicit and on the website. Nothing is hidden. You get what you pay for, and if you don't want to pay for it, then you don't get it. I think we've also provided a link for a starter kit, which is just a really simple budget calculator that they can use just to try and plug some numbers in and see what life actually looks like for them right now.
Brilliant. Steve, thank you so much for coming on the show and enlightening us all with all of this good information about
No worries. Thanks for asking me, Shelley.
Pleasure. Okay, so before I finish, I just want to remind people that please keep in mind that everything we discussed today is general in nature and it doesn't constitute any personal advice. As Steve mentioned, you can get in touch with him, or at Nucleus Wealth, we have a limited digital investment advice portal that you can get in and have a look at as well. And actually, we'll mention that we have a property calculator that can help you put through some numbers around valuations and mortgage versus rent affordability and that sort of thing. So we'll put that in the show notes as well if anyone's interested. You can get in touch with us. Contact at nucleuswealth.com if you want. If you have any feedback or ideas about the show or future episodes, please get in touch on that email address or in the YouTube comment section. That'd be fantastic. Thanks.
We forgot to mention about
yes.
do we like my first home background? This is like new modern first home.
Can we get a thumbs up if you like
all I could afford was a hipster bike and a free lounge, apparently, that I stole from, or that was just left out in the garbage because I didn't check how much I could actually afford, and I can't afford to actually furnish my house or even eat. So there you go.
And thanks to Jaden for his work and all of you for tuning in. If you know someone who would enjoy the episode, I hope you'll share it with them. And I look forward to catching you at the next one.
Thanks, guys.